Thomas had done everything the financial planning books told him to do. He was a machinist at a specialty aerospace shop in Connecticut for 38 years. His wife Joyce had been a school administrator in the same district where they lived their entire adult lives. They both contributed to their retirement accounts from the day they started working, maxed out their 401(k)s for the last 20 years. Of their careers, took advantage of catch-up contributions after age 50 and inherited a small IRA from Joyce's aunt in 2011. By the time they hit their mid-70s, their combined retirement account balance was just over $3.2 million. They had done everything right. They were the people the financial industry holds up as examples of what patient saving produces. And then they got hit with a tax and Medicare premium bill that would make any working person wince. Their required minimum distributions, their Medicare IRMA surcharges, their Social Security taxation, and their state tax on retirement income combined to eat roughly 41% of every dollar they drew from their accounts. 41%. On money they had already done the right thing with. Here is the part nobody told them. When you cross certain asset thresholds, the tax code stops treating you like a middle-class retiree and starts treating you like something else. Not a billionaire, not a CEO. Just someone whose RMDs are big enough to keep them permanently in a higher bracket, whose modified adjusted gross income stays above the top Medicare IRMA thresholds, and whose retirement income structure creates stacking problems that smaller balances never trigger. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. What we are going to walk through today is what genuinely changes when your retirement savings cross the $3 million mark, and what strategies exist to manage the different math at that level. The first thing that changes is the absolute size of your RMD. At age 73, the Uniform Lifetime Table Divisor is 26.5. On a $3 million traditional IRA, that is a required distribution of roughly $113,200 in the first RMD year. On a $4 million balance, it is about $151,000. At age 80, the divisor drops to 20.2, which on a $3 million balance becomes about $148,000. These are not small numbers. They are full household incomes flowing out of retirement accounts every single year, whether you need the money or not. And you cannot just turn them off. The IRS requires the distribution. The second thing that changes is Medicare IRMA. The highest IRMA bracket in 2024 applies to married couples filing jointly with modified adjusted gross income above $750,000. At that level, each spouse pays an additional approximately $419 per month above the base Part B premium, plus an additional $81 per month for Part D. Annualized, that is about $6,000 per spouse, $12,000 for the couple, just in IRMA surcharges. The next bracket down, which applies between about $386,000 and $750,000, is about $5,000 per spouse annualized. $3 million of traditional retirement assets producing a $100,000+ RMD alongside Social Security and other income can easily park a couple in the second or third IRMA bracket from age 73 onward. The third thing that changes is Social Security taxation. Above the combined income thresholds, up to 85% of Social Security becomes federally taxable. At the $3 million portfolio level with typical RMDs, that 85% is essentially certain. Your Social Security, which you paid into for 40 years with after-tax payroll deductions, is now being taxed again at up to 85% inclusion. That pushes the effective marginal rate on an additional dollar of retirement income even higher, because that dollar can pull more Social Security into the taxable zone at the same time. The fourth thing that changes is the net investment income tax. Above modified adjusted gross income of $250,000 for married filing jointly, investment income, including interest, dividends, capital gains, and rental income in most cases, gets hit with an additional 3.8% federal tax. At the $3 million portfolio level, your taxable brokerage account distributions and capital gains flow through NIT essentially every year. The fifth thing that changes is the additional Medicare tax on earned income. If you have any earned income in retirement, consulting, board seats, part-time work, above $250,000 for married filing, jointly, an extra 0.9% Medicare tax applies. And the sixth, and least understood, is the interaction between RMDs and estate planning. A large traditional IRA passed to non-spouse beneficiaries now has to be fully distributed within 10 years under Secure Act rules, with annual distributions required in most cases under the 2024 final regulations. That means your children, who may be in their peak earning years, will be forced to pull down a $3 million inheritance over 10 years on top of their own W-2 income. A surgeon child or an attorney child in their prime earning decade could see inherited distributions taxed at 37% federal plus state tax. Your estate planning decisions made decades ago in a world where the stretch IRA let a grandchild pull distributions over 70 years are now operating under a 10-year window. The stacking effect across all of these is what makes the $3 million and up portfolio experience feel completely different from a $750,000 portfolio experience. It is not just that you owe more taxes, it is that each additional dollar of income triggers multiple surcharges simultaneously. A $100,000 RMD is not taxed at one bracket. It is taxed at your marginal federal bracket plus state, plus it pulls Social Security into taxation, plus it moves you into a higher IRMA tier, plus it contributes to NIIT exposure. So what strategies actually exist at this level? The first is the long Roth conversion runway. If you have years between the last year of working income and your required beginning date for RMDs, you have a window to systematically convert traditional IRA dollars to Roth dollars at managed marginal rates. For a couple retiring at 65 with RMDs starting at 73, that is potentially 8 years of conversions at whatever bracket you choose to target. Converting $150,000 per year for 8 years pulls $1.2 million out of the future RMD base. At current rates and assumed growth, that can reduce future RMDs by roughly $50,000 per year for the rest of the retiree's life, with corresponding reductions in IRMA, Social Security taxation, and NIIT exposure. The math on this is not trivial. Converting in a 24% bracket to avoid a future 32% bracket plus IRMA plus Social Security stacking can net roughly 15 cents on every dollar converted over the long run. Against a 1.2 million conversion, that is roughly $180,000 in lifetime tax savings before accounting for estate planning benefits. The second strategy is the qualified charitable distribution. Once you are 70 and a half, you can direct up to $105,000 per year in 2024, indexed for inflation going forward, directly from your IRA to a qualified charity. The QCD counts toward your RMD and is not included in adjusted gross income. For a charitably inclined retiree with a $3 million IRA and a $100,000 RMD, a full QCD of $105,000 can effectively satisfy the entire RMD while generating zero federal taxable income from the distribution. The downstream effect on Social Security taxation and Medicare IRMA is significant. Eleanor, a retired school teacher from Georgia with a combined portfolio of $3.1 million, gives roughly $30,000 a year to her church, her alma mater, and a local food bank. Before her CPA restructured the approach, she was giving from her checking account after receiving her RMD and taking itemized deductions on Schedule A. After restructuring, she directs $30,000 of her RMD as a QCD. Her charities receive the same $30,000. Her RMD is partially satisfied with zero AGI impact on that portion. Her adjusted gross income drops by $30,000, which keeps her below an IRMA tier threshold, saving roughly $2,700 in Medicare premiums for the year. She effectively turned a charitable gift into a tax structure improvement without changing the amount given. The third strategy is asset location. In a $3 million portfolio, how your money is located matters enormously. Bonds generating ordinary interest income belong in traditional IRAs, where the distributions will already be ordinary income. growth stocks that compound with long-term capital gains, and qualified dividends belong in taxable brokerage accounts, where they benefit from preferential tax rates and a stepped-up basis at death. Alternative investments with complicated tax reporting belong in IRAs to avoid paperwork complexity on personal returns. Getting the asset location right can save meaningful dollars annually over a 30-year retirement. The fourth strategy is estate tax planning with a focus on basis and beneficiaries. The federal estate tax exemption for 2024 is about $13.6 million per person. So most retirees with $3 million portfolios are well below the federal threshold. But state estate and inheritance taxes in states like Massachusetts, Oregon, Washington, and several others kick in at much lower thresholds, some as low as $1 million. Retirees with significant assets in those states need to be aware of state-level estate tax exposure. Beyond tax, the bigger issue for $3 million plus portfolios is the 10-year distribution requirement on inherited IRAs. If your child is in a 32 or 35% bracket and inherits a $2 million traditional IRA, the forced distribution over 10 years can result in $400,000 or more in federal tax. Converting portions of your traditional IRA to Roth during your lifetime, at lower bracket rates, shifts that tax burden from your children's high earning years to your own lower bracket retirement years. The intergenerational math favors conversion when the next generation's bracket will be higher than yours. The fifth strategy is coordinating withdrawals from 3 tax buckets. A typical $3 million retiree has 3 buckets: taxable brokerage, traditional IRA or 401k, Roth IRA or Roth 401k. Each bucket has different tax treatment. Pulling from the taxable bucket can generate long-term capital gains at favorable rates. Pulling from the traditional bucket generates ordinary income that is always taxed at your full bracket. Pulling from the Roth bucket is usually tax-free. A thoughtful withdrawal sequence, coordinated with RMDs, QCDs, Social Security claiming, and conversion opportunities, can reduce lifetime tax by hundreds of thousands on a $3 million base. The sixth strategy is timing discretionary income. If you know you are going to sell a rental property, a business interest, a vacation home, or a concentrated stock position, the timing of that sale matters. Stacking a big capital gain on top of a high RMD year can push you into top brackets plus NIIT plus top IRMAA. Spreading it across 2 tax years or doing it in a year before RMDs begin can save real money. Frank, a retired truck driver from Texas with a $3 million plus portfolio built through disciplined saving and a side business he sold for $800,000 in 2012, held a concentrated position in the acquiring company's stock. By 2024, the position was worth about $600,000 with a cost basis of about $800,000 because the stock had declined. He could have sold the entire position and generated a $200,000 long-term capital loss, which would have offset other capital gains and up to $3,000 of ordinary income, with carryover of the remainder. His CPA identified this as a tax loss harvesting opportunity in a high RMD year. Selling in 2024 reduced his 2024 capital gains elsewhere in the portfolio to near zero, eliminated about $30,000 in NIIT exposure, and created a carryover loss he would use in future years. Strategic timing, not avoidance. The seventh strategy, which is often overlooked, is Roth 401k, contributions while still working. Under Secure 2.0, catch-up contributions for high earners will eventually be required to be Roth contributions rather than pre-tax. For a retiree still working part-time with a high enough wage base, Roth 401k contributions effectively add to the tax-free bucket. This is a niche strategy, but worth considering if you have consulting or part-time income. What about the retirees who just crossed into this 3 million plus world and feel overwhelmed? The honest answer is that at this asset level, working with a qualified tax professional, a fiduciary financial advisor, and potentially an estate planning attorney is no longer optional in the way it is for a smaller portfolio. The stakes on individual decisions are too high, and the coordination across tax, Medicare, Social Security, and estate planning is too complex for DIY. The difference between a well-coordinated $3 million retirement and a poorly coordinated one can easily be $300,000 to $700,000 over a 30-year retirement. That is worth the professional fees many times over. Here is the checklist I would encourage you to run through if you are approaching or already in this range. Know your 3 buckets: traditional, Roth, taxable. Get the exact balances of each, updated as of year end. Map out the next 10 years of expected income: RMDs, Social Security, pension, interest and dividends, part-time work, rental income. Put it on a timeline. Identify the years between retirement and your required beginning date. Those are your conversion window years. Target a marginal rate for conversions and build the schedule. Review your beneficiary designations on every retirement account. Confirm they reflect your current wishes and your current understanding of Secure Act 10-year rules. If you give to charity, implement QCDs once you are eligible. The structure matters as much as the amount. Review your asset location. Rebalance across accounts so bonds are. In traditional IRAs, growth is in taxable. Roth holds your highest return assets. Know your RMD thresholds. The 2024 brackets for married filing jointly are roughly $206,000, $258,000, $326,000, $386,000, and $750,000. Each threshold costs real money. Coordinate Medicare enrollment, Social Security claiming, pension start dates, RMD timing, and conversion schedule as one integrated plan. These are not separate decisions. Update your estate documents, wills, trusts, powers of attorney, healthcare directives, beneficiary designations. The last time most people touched these was a decade ago, and the legal and tax landscape has changed meaningfully. Review your state tax exposure. Some states are very friendly to retirees. Others tax retirement income heavily. State tax planning can matter as much as federal planning at this asset level. Plan for the survivor. When one spouse passes, the survivor moves. From married filing jointly brackets to single filer brackets, which are roughly half the width. The same income produces a significantly higher tax bill. Plan conversions and withdrawal sequencing with an eye toward what happens after the first death. Plan for the next generation. If your heirs will inherit a substantial traditional IRA, the 10-year rule on inherited IRAs may cost them hundreds of thousands in tax. Lifetime conversion strategy can shift that burden to your lower bracket retirement years. Thomas and Joyce, the couple I described at the start, eventually worked with a tax-focused advisor who mapped out a 6-year Roth conversion schedule, implemented QCDs for their charitable giving, restructured their asset location, and filed updated beneficiary designations. Their projected lifetime tax savings across the 2 spouses and the pass-through to their children was estimated at roughly $440,000. It did not change their lifestyle at all. It did not reduce their giving. It changed the paperwork and the structure, which produced the savings. The work was front-loaded into the first 18 months, after which the annual maintenance became straightforward. The broader truth is that tax rules are progressive by design, which means the IRS takes a larger and larger percentage of each additional dollar of income. At the $3 million plus portfolio level, you are permanently on the high side of those progressive rates unless you actively manage your income down through conversions, QCDs, and careful timing. Doing nothing is a choice, and it is an expensive one. Most retirees who reach this level got here through discipline, not luck. Same discipline applied to the tax and withdrawal side of the equation produces outsized results because the dollars at stake are larger and the stacking effects are more severe. I hope this walkthrough gave you a clearer sense of what changes when your retirement savings cross the $3 million mark. If it did, a brief note in the comments helps this channel reach other retirees in the same situation, because platforms amplify what people engage with. Your comment might be the reason another viewer finds this information in time to act on it. And if you are in this range and have not yet connected with a tax-focused advisor and a CPA who work together, consider making that your project for the next 60 days. The numbers are large enough that professional coordination pays for itself many times over. Thank you for the time, and take good care of yourself and the people who depend on you.